exciting changes in financing. We're actually starting a minute late because we got sidetracked in a discussion on this. I'm Bill Gross. Welcome to our Homebuyer Seminar with my good friend and colleague, Patricia Castillo, and our good friend, Gustavo Segura, lender. And we're going to talk about, among other things, there's a program that's getting a lot of attention. The question is it good for you or not? And Gustavo and Patricia were talking about in detail.
Yeah, so this is something that I kind of stumbled upon because we're always looking for different programs that are going to help our buyers get into a property. So, right now everybody's talking about the Dream for All program that's offered here in California, and it's a shared equity program. So you get the 20% down payment, and then once you pay off that loan or there's a title transfer, so let's say you refinance or you sell the property, then at that point, that 20% loan is due payable, and also a portion of the equity that's appreciated since you obtained that loan. So today we were just going to touch a little bit on something similar in the sense that it's a little different. It's 100% financing that is available through FHA. So FHA allows you to put down, first-time home buyers put down 3.5% on the loan, so that on the down payment, so that it's very, it's easier to come in with 3.5% than it is to come in with like 10 or 20% down as a first-time home buyer. So this FHA program is basically facilitating that hurdle, which is the down payment, and it's providing a 100% financing option. But, as what's that saying? There's no free lunch, right? So there's always some caveat that's, that comes along with something that sounds like such a great opportunity. So we were going to touch on that a little bit today. This does sound like a good opportunity in a sense that, I think just thinking about the differences with each program, which we'll kind of go into right now, you can make the decision yourself and see what would be the best program to use if you did need down payment assistance. So Gustavo, thank you so much. You're always here on our call, and we're happy to have you with us. So just wanted to open up the conversation and talk about the 100% financing option with FHA and see what that looks like for first-time home buyers.
Yeah, no, thank you. And so I want to clarify one thing. So FHA is not offering 100%. So with FHA, the best you can do is still that 3.5% down. So you're still going to have, that's like the first mortgage. But what lenders are doing is they're trying to help and come up with the other 3.5%. So the FHA program is still the same 3.5% minimum down payment. You're required to do that. But then the lender are coming in with a second loan to help you come up with that 3.5%. So then they try to market that as, it's an FHA loan. So it could be a little bit confusing out there. So what you end up having are two loans. You end up having a first loan, which is secured through FHA. You still have that 3.5% required down payment. You're getting that second loan from that lender, and you're able now to have that money come to the table, right? As far as 100% financing. Now, it does help you because you have no out-of-pocket expenses, but there's, like you said, there's little caveats here that we need to look at. And part of that is you're at 100%, you're going to get a higher rate. What the lenders are doing, they're giving you a higher rate on that FHA loan, the first one. And then on that second loan, it's usually about 2% higher. That's what I've been seeing out there. Okay. So sometimes it could be a little bit misleading, because then you think, oh, FHA and it's 100%. Well, I know that the FHA rates are below 6%. And then you think you're going to get that. But once you start talking to them, you start realizing that you're going to get 6.5%, 7% on the first loan, FHA. And then second loan, you're looking at 8.5%, 9%. So that's where that's where they make their money. And of course, that's where you end up paying for not having that 3.5% down. So I would continue to recommend buyers, if you've got that 3% or 3.5%, take advantage of that and get your down payment. The guidelines right now are set up so that you can get a great rate FHA just reduced their monthly insurance cost. So you can still get a great rate below 6% and be able to take advantage of home ownership. If you can't do that, there's some options. Is this option the right one for you? We have to take a look at it, because with the rate being higher, your payment now is going to be higher on both loans, on the first one and the second one. So that's where your payment may just be too high to even qualify for that. But again, sometimes we hear a lot of things out here and it could be confusing, and it may not be right for everybody.
Right. So that's why, it's so important to really go deeper into these options, because the only thing that buyers see, and even us as realtors, we see what looks like something that's really fantastic for buyers, and it looks really appealing. So of course, they wave the shiny penny so that buyers can look at these options, and maybe they can secure financing that way. But let's just say, for example, on a $600,000 purchase, if you're putting in 3.5%, that's about $21,000. So you're saying that for that $21,000, the interest rate would be higher, about 8.5% to 9%.
Exactly. Yeah.
Right?
On that second one, they're going to be charging you somewhere.
Yeah.
Just that 21,000.
Okay. So I mean, it's a smaller amount, obviously, the second loan than the first loan. So it just depends on what the monthly payment looks like, because if you're financing 21,000 at 9%, is that for 30 years also?
No, a lot of times they'll do it for 10 years. So they shorten that out, because if they do to 30 years, it's going to be like $20, right?
Right.
So then they want their money faster. They want that interest. So that's what happens. The other thing too is, what if the rates come down immediately here in the next 9 months and a year, right? And now you're like, hey, I want to take advantage of that, right? So there's going to be things that you got to look at to see, are they going to subordinate that second? Are you going to come across that? Because you're not going to have necessarily equity on the house. You're at 100% financing. And, that was kind of the issue back in 2008. People were 100% or maybe 105% if the property came down a little bit, and they could not refinance. They could not take advantage of a lower rate. And then they started letting go of those homes. And that's where the risk comes in. And that's where, the FHA conventional, they're like, hey, we need at least 3% or 3.5 to try to avoid those situations. And when we're seeing these kinds of new lending loans come in, it could be a little bit not scary, but you got to just be cautious about,
concerning,
is it
right?
going to work? Yeah, a little bit concerning. About like, okay, we're giving people again 100% financing, 2 loans. Is this, and then what if they can't refinance because you're not going to subordinate that second,
or they're underwater, right?
Right. And the biggest thing is going to be, are they going to subordinate that second when you try to refinance? For most of the time, they do subordinate those seconds. But what if they don't? It just causes a little bit more issue. And then what if you can't refinance into a lower rate? Now you're stuck on that. And that's where the borrower is going to say, well, forget it. I'm out of this house then. And then that creates, another issue. So it's just, we got to go through the options.
I think the advantage, I've changed 180 degrees on this, because pre-2008-9, I would have said, don't get 100%, because if you get upside down, you face foreclosure, and that's bad. Today, I would say the opposite. If you can qualify for this loan with 100%, get it. Keep the cash in the bank. Because if, in fact, houses go upside down and you have to walk from the property and can't afford it, it's non-recourse, meaning they can't come after you for anything but to take the house back. It's gone down in value, so you give it back. Foreclosure is not that big a deal, and most of these banks will work with you on a short sale if they have to. We just watched the federal government bail out the second, third largest bank in history to avoid problems. I'm not saying that people should be reckless. What I am saying is there's a protection law called non-recourse. You buy a property, unless you refinance, you don't have any financial risk. If it goes down in value, you give back to the bank and say, sorry, I can't afford it. And they foreclose. It hurts your credit, but it's not a bankruptcy. It's not worth bankrupting yourself over. And I would say, to me, some buyers should look at this program who don't need it. Not the buyers who need the program. They're the ones who are getting set up for failure. But I think there are buyers who don't need it, And yes, it's going to be hard to get that second loan. It's going to take long. It's going to be a longer escrow. The government's horrible to work with. All that's true. But if you could take 20% on a, I don't know what house would qualify for it, $400,000 house, 20% is $80,000, and keep that in the bank instead of putting us down payment, that's protection in case housing values did drop. I think that's a reasonable way to protect yourself, and you should think about it. And I think that we were trained to think it's so bad to face foreclosure, and I don't think it's good. But I also think that you should use the law to protect yourself. That's what wealthy people do. That's how our government is operating today, is protecting people using the laws. I wouldn't fraud anything. I wouldn't get the loan out without playing by the rules properly and disclosing. But I think this is an opportunity. I'd say this: if you're applying for a home loan, you should at least walk with your lenders, see that program you could qualify for it, whether you need it or not. It might be more expensive, but it might be nice to keep that money in the bank. Just something to think about. I'm not saying to do it. I'm saying look at the options and weigh them. And if you have a way to get into that, I have an escrow right now where we had to waive contingencies and then wait 60 days to remove a tenant. And the truth is, a tenant might take 75 days or 80 days to actually get out. That's not uncommon. So they could apply for this loan, and if it took 60 days, it's not a problem. They have 60 days plus. And so to me, it's one of those cases where the buyer should say, I wonder if that would work for me as a way to hold on to cash. And then my buyer in this case is an investor. I think she'd like to hold on to the money. So I'm going to have her talk to somebody, maybe talk to you, Gustavo, and say, is this an option? And really, what does it cost me more monthly? But maybe it's worth it to her to have the money in the bank?
Right. And it's nice to just hold on to that capital in case,
Yeah.
You need it in the near future, right? Because of course we don't know what's going to happen with the market in the future and with jobs and things like that. But at least you're not using, some people are pouring everything they've got into buying a home.
Right.
So if you can hold on to that 21,000, let's say, you might have repairs on the home. There might be something that you need to, take care of. People are usually not used to paying property taxes if they've been renting for a while. So all those things are, something to consider when you're buying a home, and also just seeing what option is going to work better for your individual situation.
Right.
And, part of the new guidelines that came out is to help low down payment borrowers. So, even if you do have that 3 or 3.5%, you're going to get a better interest rate than someone that's putting down 15 or 20%. So it used to be the other way around, where if you're putting down 15 or 20, you were getting a better rate. But that wasn't promoting a lot of new home ownership, because, nobody has a lot of money like that, just sitting around. They have to save. Well, now, they can get $20,000 saved, or they can get a gift from a family member. So when you compare a rate of, say 5.5% on FHA, and then now you're going to get a higher rate on that same amount, that's going to be 6.5 or 7, plus you're going to be adding the other one. You're going to be paying through the payment. So that's why I like to make sure that they understand the rate, the payment, and the opportunity. Yes, you might get $20,000, but you're going to be in here, and it's going to be, how flexible is it going to be or not? And then what is that going to do to you later on? Even if you go into a foreclosure later on, if that happens, imagine if that happens, if you walk away from it, what is that going to do for the next time you want to buy? So we talk about roadmaps. You got to also take a look at that roadmap and see what happens if you go down that path, because your rate next time is not going to be that 5.5%. It's going to be a little bit different, and you may have to wait a little bit. The other thing too, when you guys are getting those offers and you guys are getting 100% financing, how competitive is that versus a 5%, 10%, or 20%? So, are they going to realistically have a chance to get a home? If you're seeing that they have 100% financing, they're going to be dealing with 2 loans, and that second loan is going to be basically like this private loan that's going to be, a piggyback loan on it. So those are all things and good conversations to be aware of, so that the agent knows what's going to happen, because they got to do their due diligence when they go ahead and make an offer, right? How are we going to make that offer look better? And then the buyer's got to understand what they're paying for, or what they're not paying for as well.
Yeah, absolutely. And when you're acting as a listing agent, of course, you're going to want to guide your seller with the offers that are coming in and highlighting all of the offers that look the best.
Mhm.
And, you want to make sure that they're going to close escrow. The last thing you want to do is go back on the market because they maybe didn't qualify for the loan.
Yeah.
After all, they sent in an offer over asking, and that's not truly what they can afford. So it's hard because you want people to get into a home, but as a listing agent, if you're looking at the offers and, these people seem like they're just barely, making it, it's kind of tough to really root for that offer, right? Because
Yeah.
you have other offers, like you said, that might be coming in at 5 or 10% down. So you really have to, that happened to me once last year. I had an agent called me and she said, I'm just going to be upfront with you before we even send the offer. I'm just letting you know that, my client just has enough. They qualified for financing, but they only qualified to put down like 3%, and they barely had enough money in the bank to send in not even a 2% earnest money deposit. They were going to send in like $1,000, and then they just had money to pay for the appraisal and the inspection and open escrow, and she was going to help them a little bit with their closing costs. So they were barely, getting by. So.
Did they close?
No, of course, we didn't end up selecting their offer.
Yeah.
We did go with an FHA offer, but they were putting down 5%, and the scenario just looked better, because you want to make sure that there is, the buyer has that financial solvency there to be able to close the deal.
And that's the thing that they look good for marketing purposes. I can go out here and I can say 0%, fees, points, all that kind of stuff, right? And yes, that's possible. But it's a different rate, it's different everything, right? Once you get into it. Just like I mentioned to you guys, you go into some of the big lenders and they're advertising right now 5.625 conventional loan. And it's like, well, how does that happen? You look at the disclaimers and they're charging 3 points and they want at least 25% down payment on it. So yeah, it is doable. And they can market that rate, just like these programs now are starting to come out and they market them, but they're not always appealing to both the agents and also to the buyer, because it is going to be a little bit more restrictive in the future. Their payments are going to be higher, so they may be more likely to get away from it. This is kind of how it started, back in 2008. Oh, you can get in this with 100% financing, no responsibility for it.
Well, it's a little different than that. In 2008, you didn't have to have a job, you didn't have to have income, you have to say where your job was, you have lousy credit, and you could put no money down. That was a whole nother level of this. I think this is
got there. We started.
Right. No, well, I don't know about that. These kind of programs have always been around. No, it is very limited in how many people can get it. This is a way for the politicians to say, see, we're helping solve the housing affordability problem. And it really does nothing, because until we build more houses are going to be expensive and they won't be able to afford the houses. But there's only, I think, 2,500 families in California that can even qualify for this program. It's only funded for 2,500 families total. So it's not even designed to be that.
So you're talking about the Dream for All, right?
Specifically. And I just think in general, these 100% programs, these companies announce it, but then when you read the fine print, they only have so much money available that they're really going to offer to it.
But these 100%, it's not the government. So that's what I want to be clear up, is that they're saying FHA 100%, but it's not like FHA is giving you that other 3.5. It's the
Correct.
lenders that are getting creative and saying, I'm going to give you the other 3.5%. And because of that, I need some kind of reward, and I need to make something out of it, which is going to be a higher rate and maybe higher fees.
Plus, they're only do so many of Bank of America, Wells Fargo, only do so many of them. They're just trying to placate the congressmen in those districts who are doing them. This is, again, they're not going to give them to everybody. Even if everybody lined up in America to get the loan, they're not going to give them everybody the loan. They're only going to do so many of them. This is a political move to ingratiate themselves to the public. But this is not a new product. Whereas in 2008, 2009, everybody could get those loans. It was a stampede to get them. Today, And the other part, like you say, they're price tied up, but there's not going to be that many of them anyhow. They're doing that. It's a lot more talk about loans than actual loans being issued. Is my point.
So for example, there's also, being a mortgage broker, I get to see all the different loans that are out there. They have interest only loans out there as well. They still have them. So, they're in the market, they start getting popular. You're starting to add a little bit more of those kinds of high risk into the bucket, right? Into the securities, into the second market. Right. They have, some of them started to play around with the 40-year loans. Again, they're trying to solve affordability issues, right? So and those are not backed by the government or anything like that. That is private, equities, investment, secondary market. That is, hey, let's do some of these loans. We'll make some good money on it. We'll charge it, and we kind of help people out because it's a 40-year loan. But there's risk to that. There's understanding of what could happen with that, and then you go into modification. So I just had to get a lot of people out of modifications, and it's not very positive for them to come out of those kinds of loans, because it's always going to be harder. Taking someone that is interest only and being able to go into a fully amortized rate, they're going to have a higher payment.
They're going to be in shock.
In shock, exactly.
They're going to be make that payment that includes the principal.
Mm-hmm. Mm-hmm. So it's one of those things that we just got to make sure everybody's aware of. What does it mean? Are you a good candidate for it? It's like the self-employed loans. Those are very similar in the beginning, but then you're able to qualify. Then you get more documentation, and you say, okay, this is it. You have a higher rate, but the guidelines, and we have a lot more of a bigger market for that audience.
Well, let's see how this develops. Good news is rates came down a little bit today and yesterday. So we were at 6.7, 6.6 a few days ago. We're down to 6.16 as far as the Fannie Mae market rate. So we had about a 0.5% drop in rates this week. Great opportunity if you're looking to buy a house. Get with Gustavo, lock it in, and shop for it, and go find yourself something. I think it's time to wrap up. Patricia, any last words from Pachanga Casino before you go off and have a great week or weekend out there? Any last words you want to say for us?
I'm enjoying the free water. Yeah, I'm enjoying the free water right now.
Very nice.
Yeah.
What's your contact info?
Yes. So I can be reached at 323-365-9909. We're enjoying watching all of the poppy field mountains over here.
Oh, how nice. You're enjoying the poppy field mountains. You're not harvesting them and then creating opium and selling it as a drug. You're just enjoying the view of the poppy fields. Okay, good. Yes. And Gustavo, how will somebody reach you? 714-334-4563. Text or call. More than happy to help out and answer questions. Fantastic. I'm Bill Gross. We do this home buyer seminar every Wednesday, 5 p.m. Pacific, 8 p.m. Eastern. We live stream it on YouTube, Facebook, LinkedIn, on Patricia's social medias and mine as well. Hope you have a great week. We'll see you next week, or call if we can help you. Thanks, everybody.
Thanks, everybody. Bye.
Thank you. Bye-bye.